I think when we look at macro, on the margin, things are better. We have better visibility on tariffs into 2026. We have regulation and tax, like legislation visibility into 2026. I think the Fed is now being questioned about their unwillingness to cut. I mean, it was apparent like 5 out of the 10 questions during the press conference were about that exact question. So there's a dovish Fed. I know consumers are overly cautious right now, but as you know, inflation expectations are far above CPI. That's a positive surprise if delivered inflation's lower. And then businesses have been really resilient. You know, I mean, I think actually the economy might be weakening, but earnings have been better. So overall, with all the cash on the sidelines, I mean, I would say we should be quite bullish, actually.
After months of macro turbulence and geopolitical noise, risk assets are once again showing strength. Bitcoin has surged past $17,000, not just as a speculative bounce, but as a sign of a deeper shift toward harder, more resilient assets. Global equities are climbing too, signaling that liquidity is expanding and capital is being repositioned. Yet, this rally is playing out amid lingering uncertainty. The Federal Reserve is holding rates steady despite disinflationary pressures, and inflation expectations remain elevated compared to actual CPI, hinting at a potential tailwind if conditions stabilize. Meanwhile, corporate earnings are outperforming across sectors, even as consumer sentiment remains mixed. In the clip you just heard, Tom Lee, co-founder of Fundstrat Global Advisors, presents a contrarian but data-backed view. Despite the headline risks, markets are quietly laying the groundwork for a bullish breakout. He points to regulatory clarity through 2026, a resilient corporate sector, and more than $6 trillion still sitting in money market funds as key indicators of untapped upside. According to Lee, the current environment isn't fragile, it's misunderstood. In this video, we'll dive deeper into Lee's thesis, exploring how institutional behavior is shifting, why risk assets offer asymmetric upside, and what earnings breadth and market stress indicators are really telling us. Later, we'll contrast this with Ray Dalio's concerns about long-term debt cycles, geopolitical realignments, and the fragility of fiat systems. If you're positioning capital for Q3 and beyond, these insights may help you navigate one of the most pivotal macro environments in years.
Look at this morning's action.
Well, you know, in some ways it's not a surprise because, as you know, like Art Cashin had the adage, sell the buildup, buy the invasion. And I think today is an example of that markets were kind of already nervous and anxious, and we've already saw de-risking, and the VIX was already elevated. So I think in some ways this is probably pretty typical.
Does it change your call for the rest of the year at all? And you think it displaces any other priorities or has any effect on bill passage or how that might get constructed?
Yeah, in some ways, it actually strengthens the case for stocks to do better into year-end because at the start of this year, we would have said U.S. bombing a nuclear facility is a black swan. Oil would be 120, stocks should be down 10%. And then we have the event, and oil is not really surging, and stocks are up. So I'd almost say that you've put another stress test into the market. We've seen it pass it, and I think it means stocks should do pretty well into year-end.
You think Hormuz remains a risk?
I do, but you know, Brian Sullivan was off camera was mentioning a lot of strategic reasons why that may not be the case. I'm sure he's going to have his views, but I would say I'm watching oil, and if oil isn't surging, then I think it just means that the risk of the straits being closed is lower.
This is how you buy and sell crypto the easy way, using eToro, one of the world's leading trading platforms. If you're new to crypto, eToro makes it super simple. Let me show you how I bought Solana in just a few taps. First, head to the search bar and type in Solana. Tap on it, then hit trade. I'm going to invest $10, that's the minimum. Now just hit buy and done. I now own Solana. Selling is just as easy. Go to portfolio, tap your Solana asset, then click close and confirm your sale. Super simple. That's how quick and beginner-friendly eToro is. But here's why I use eToro. Earn up to 4.3% interest on non-invested funds, 0% commission on stocks, and you can set up an account in just minutes if you want to start your crypto journey. Use my link in the description to sign up to eToro today and start trading.
Yeah, and as you know, core CPI doesn't include energy. And as you know, when the ECB looks at core inflation, they exclude housing. Housing is not part of ECB's core CPI, and they're cutting. If you calculated US CPI on the same exact basis, it's lower than Europe. So I do think there should be a dovish tilt towards the Fed, or that's the upside opportunity into year-end as well.
Tom, there seems to be a speculative nature to the market that's creeping in again. You've got a lot of SPACs coming back. I don't know if you've seen it. Yeah. Even Chamath is coming back with some SPACs. Any concern to you or no?
It is. I mean, those are echoes of 2021, which is some stocks get fantastically bizarre valuations, and I'm not naming any. And
you want to name some?
And then there is signs of speculation. And but the one thing that was true in 2021 that's not true now is when I meet with fund managers, in 2021 they said there was no stock they could buy because everything was expensive. That's actually not true anymore. Now the people I talk to are saying, look, the numbers have been better and numbers are going up, but the macro is making them uncertain. So there's actually a lot less risk taking by institutional investors. Yeah, I mean, to me, David, it's a sign that the cohort that is speculating are the ones that bought the dip in April. As you know, it was retail, the Robinhood community, that was buying in April when institutions were selling and raising cash and high net worth was raising cash. So it's the same crew now that is buying, the circles at one time's assets under management, which is tremendous. But it's not speculation to me yet because I'd say high net worth is not really that invested and institutions are still pretty cautious.
But what is the underlying view that you have that makes you bullish? Is it that the economy is hanging in? Is it that earnings are picking up? What's the fundamental reason?
I think when we look at macro, on the margin, things are better. We have better visibility on tariffs into 2026. We have regulation and tax legislation visibility into 2026. I think the Fed is now being questioned about their unwillingness to cut. I mean, it was apparent 5 out of the 10 questions during the press conference were about that exact question. So there's a dovish Fed. I know consumers are overly cautious right now, but as you know, inflation expectations are far above CPI. That's a positive surprise if delivered inflation's lower. And then businesses have been really resilient. I think actually the economy might be weakening, but earnings have been better. So overall, with all the cash on the sidelines, I would say we should be quite bullish, actually.
Tom Lee's optimism isn't just sentiment, it's grounded in positioning. He highlights that roughly $7 trillion remains parked in money market funds and short-duration treasuries, nearly double pre-pandemic levels. This cautious stance, especially from institutional investors, has kept a large cash cushion on the sidelines. In a typical equity rally, sidelined cash provides a buffer, but with Bitcoin already past $100,000, that cash represents a potential fuel source. Even a small rotation of that capital into crypto, via ETF flows, treasury diversification, or risk parity adjustments, could trigger exponential price growth. Unlike equities, crypto's thin float and high reflexivity mean demand shocks quickly reprice the entire curve. While hedge funds are beginning to rotate in, pension funds and sovereign wealth portfolios are just starting to explore crypto exposure. Tom sees this lag as a bullish asymmetry that could drive a prolonged revaluation of digital assets, especially if macro conditions stabilize. However, not everyone shares this calm outlook. While Tom Lee sees opportunity in growing visibility, Ray Dalio warns of risk stemming from systemic fragility, a theme he explores in his new book, How Countries Go Broke. The Bridgewater founder has recently sounded alarms not about asset prices, but about the global financial architecture itself. Dalio points to 3 interconnected pressures: soaring debt levels, rising geopolitical tensions, and eroding trust in fiat currencies. In his view, we're not just at the end of a market cycle, we're in the midst of a global realignment.
And I wrote the book is that for about 50 years I've been in the markets betting on these things, and I wanted to convey the mechanics of how the process works. So think about it this way. The credit system is like the circulatory system, and that it brings buying power throughout the economy, and by creating credit, you create buying power, and that creates debt. But if that debt produces income, then that's a healthy system. If it doesn't, it produces interest rates and debt service that build up and crowd out spending. And so we can see that happening to the government. So now interest rates, for example, are now $1 trillion. So let me put the budget in perspective. That number that you gave is a wrong number because it is the amount of deficit on top of the amount of deficit that would be there. $7 trillion is the amount the government spends every year. It takes in $5 trillion. As a result, it's got a $2 trillion deficit. And it works the same for governments as it works for individuals or companies, except the government can print money. And so that is building up. Over the next 10 years, it's going to increase by the debt, and the debt service is going to increase by more than 10 times that $2.5 trillion number, because that number was a number on top of the deficit. So what we're having is a crowding out, like in plaque building up in the system, a crowding out of spending. And that amount of debt now is about $230,000 per person. So you can see it happen in that way. In addition, you have supply-demand issues. In other words, one man's debts are another man's assets. And when there's a lot of more debt that's being sold, then you have a demand problem, not an adequate amount of demand. We're seeing this happen now as central banks and foreign investors are buying less and, in fact, shifting to gold. So there's that dynamic that I'm trying to convey the mechanics of. It's not political, and there's something we can do about that, what I call the 3% solution. And you could see it. Okay, if you understand the mechanics, you can actually see it. So you could see that this debt service has now crowding out spending. So you can see you can't cut spending very much, it's fixed. And that the interest continues to build up that way. And you like plaque. So if I was a doctor looking at your circumstances, and I could show you that building up and I could show you that crowding out, you can also see the supply relative to the demand. And you could see the big imbalance. And then there's the big risk that not only is the supply of new supply a problem, but also those who are holding the bonds may not think they're going to get a good real return. If you study history and you see this, you would not want to hold those bonds expecting a good real return, and you could see selling. And so that dynamic is, you can see it mechanically. And you could also see that we are at the point in that cycle that the adding that debt from just this next year and the next 2 years will put us over the edge, could put us over the edge, very close to that, because you're now having the need to create debt in order to pay the debt. And so when you see these debt cycles, there are something like 50 of them looked at in this book. When you get that the debt is having to pay the debt, then what happens? You have the government come in and the central bank, and you have printing money. You're entirely right. From 1991 until 1998, they reduced the federal debt by 5% of GDP. We could cut the federal debt right now if it's done in a certain way, 3 ways. You can cut that down to 3% of GDP. You need a 3% of GDP. It's now going to be about 7% of GDP. If you can cut that down to 3% of GDP, then you change the supply demand, and you don't have that compounding effect. And there are 3 ways to do that, and they have to be balanced. The 3 ways are, of course, in spending and in and tax revenue. I'll emphasize revenue, and also then interest rates, because interest is such a big component of the debt. If there's lower interest rates, but you can't force those interest rates down, because bondholders won't want to hold it if they get a poor interest rate. But you have a situation where if you change the supply and demand, you will naturally have a lower interest rate. So we're at that point now.
I wonder, Ray, if it is indeed possible, in your view, to get to your 3%. Without cutting Medicare, Medicaid, Social Security.
The way I do the numbers, I find if you could take it about a 4% cut in spending and a 4% improvement in tax revenue, that you would get enough of a decrease in the deficit that you would also naturally have about 100 basis points, maybe more, decrease in interest rates, and you get very close to that you have to, so you have to bring it in that order of magnitude. I'm not saying that that's easy, but it's a political question. When I go to Washington and I speak to people on both sides, everybody agrees with what I'm saying. I mean, meaning that you have to get it to 3% of GDP and so on. But it's political because it's like being on a boat headed to rocks. And on the boat, everybody agrees you have to turn. And they can't agree whether you turn left or you turn right, and they're going to go right into the rocks. And so it's a political question. I think the period from 1991 to 1998 that also Joe is referring to is a good model period to take a look at how to best do it and realize that the consequences of not doing it are disastrous.
While market bulls like Tom Lee focus on visible upside and positive earnings, Ray Dalio urges investors to look deeper, beyond price movements and quarterly reports, to the very foundations of the global economic order. Dalio's core thesis, shaped by decades studying long-term debt cycles, warns that we are in the late stages of a fragile monetary and geopolitical system. Historic public and private debt burdens are becoming increasingly difficult to service amid elevated interest rates and slowing growth. This has led to financial repression policies that penalize savers and distort capital allocation to maintain stability. But Dalio believes the challenges run deeper, pointing to a shift toward a fragmented, multipolar world where the dominance of the US dollar is no longer guaranteed and trust between major powers is eroding due to weaponized finance and broken supply chains. In this new reality, international cooperation is giving way to strategic competition, reshaping trade, capital flows, and reserve management. As trust in institutions and fiat currencies wanes, people seek refuge in alternative stores of value, gold, productive assets, and increasingly digital assets like Bitcoin. Unlike traditional currencies, Bitcoin operates on decentralized code with a fixed supply, offering a unique hedge against monetary debasement, capital controls, and institutional decay. Dalio, while cautious about regulatory and adoption risks, acknowledges Bitcoin's evolving role as a digital alternative to gold, a non-sovereign, censorship-resistant, and portable store of value gaining practical relevance in a fragmented world. For individual investors, Dalio's advice is clear. Diversify globally, hold assets outside the traditional fiat system, and prepare for volatility by focusing on resilience over returns. Where Tom Lee sees near-term tailwinds from strong earnings and abundant cash waiting to be deployed, Dalio asks a deeper question. How will your portfolio perform when the global system itself changes? In that context, crypto is not just a speculative trade but a strategic structural allocation to preserve purchasing power, mobility, and optionality amid growing uncertainty. So, do you align more with Lee's bullish outlook or Dalio's systemic warnings? Drop a comment below.
For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.